All right, good morning, South Florida. I'm gonna try to do the tax tip for this week via video and the ones that will be following this week. And you'll probably see me more in the car, the traffic light, maybe even driving. If I'm driving, I won't look at the camera, of course, because I gotta pay attention. Some people may think it's dangerous, but I feel it's the same as if you are right here in my car and I'm talking to you, as long as I'm not looking at the camera. And right now I'm in a traffic light. The traffic in South Florida is insane, so I have plenty of time and I cannot do tax returns or stuff that I can actually bill. So I'll do the freebies, which is the videos. So this week I want to talk about tax residency. A lot of people get confused with that. There are two tests basically, unless you're in a treaty country. The tests are the green card test or physical presence test. Green card test, pretty easy. If you have a green card or get a green card or approved, then you're considered a tax resident for tax return purposes. So, and you also, of course, resident for immigration purposes. The second test is a more complicated one, or the people get confused about, is the physical presence. Depending on how long you are in the US, you can be illegal, legal, out of status, in status, whatever you want to call it. You're considered a tax resident. So you have to file a tax return as a resident. So the test is somewhat complicated. If you are 183 days in a year, more than that, it's about 6 months, then automatically you are a tax resident. But the formula actually goes back 3 years. So you count total days in the current year, 1/3 of the days of the prior year, and then 1/6 of the days the third year prior. And then you add all that, and if equals more than 183 days, then you're also considered a tax resident starting the current year. So why is it important to know that? The reason why it's important is if you're a tax resident, if you're a US tax resident or citizen, you have to declare your worldwide income. So it doesn't matter how much money you make outside the US, you have to put in your tax return here. And it becomes very relevant when other jurisdictions or other countries have lower tax rates. So you can, in most countries, you can get a tax credit for what you pay outside the US. So if you paid whatever amount in Switzerland, you can get the credit for what you paid there, in most cases over here. But the problem is if you paid 5% tax there and you made $1 million, you're gonna pay the difference here. And as you may know or not know, the top tax bracket right now, it's 39.6%. So you'll be paying, the 34-35% extra. So that's the tax tip for this week. Tax residency. If you're not a resident and you have investments, a house or whatever here in the US, just watch the days you spend here and make sure you understand if you want to become a resident or not, because if you do not want to become one, you want to make sure you plan around that. So next week we'll have some more. If you have some other questions or common questions that you always get confused about, of course, if it is something more specific, that's why I am an accountant, a CPA. It's to give advice and do tax returns. But I feel some general information is important for the public, and those of you that follow me, I want to give those freebies to you so that you understand a little bit of tax law. Then if it gets too complicated, of course, I'll be here to help, or just ask your tax advisor. Okay? Have a great day, tax wise.